live. YouTube, LinkedIn, Twitter, Facebook, and in person. All right, let's get started here. Hello, Smart Money Tree podcast listeners. Welcome to the show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today?
Doing well. Doing well. My oldest son had a day off for conferences, so I got a chance to do a little stick and puck on the rink a little bit from here. It's a little out of shape. I'm winded. Still breathing heavy. It was only like half an hour ago. I'm like, Jesus, I'm
It,
out of
it,
shape.
it sounds like fun, though. It's always good to do stuff with the kids.
Yeah, it was fun. I mean, he didn't have as much fun as a bunch of old dudes. They were like 5 times his age, and he's out there skating around them like they're standing still, and most of them were, and it was fun, but it was definitely like, all right. He was like, I didn't have fun. Like, okay, I get it. You want to be with people your own age. You don't want to hurt grandpa. I get it. But I feel like I was grandpa out there too. I felt good, and for the second shift, I lost my wind. I need my endurance back. I don't have what I used to have, but either way, it was fun and glad to do it. And so I'm just glad I'm here in all in one piece.
That's the big thing. I'll tell you, when my kids were younger, we didn't do it on skates, but we would do like soccer and basketball and stuff like that. What amazed me was how serious certain parents took it.
Yeah.
It's your kids, right? And
Yeah.
they were out there like going for bear. It was crazy.
It's funny how many high school heroes there are. And like, I remember when I was living in the city, we used to go to Boston Common, and a bunch of the Beacon Hill dads would go out there and we would play like flag football. And some of the dads out there were actually like legitimate football players. It wasn't just like a bunch of like beer belly dads. It's like some guys actually played in college. And like one of my friends like was playing too hard, ended up getting concussion because he just got a knee to the head or whatever it was. And he's telling me this story, and he's like, "Hey, man, we could really use you next week." I'm like, "I'm good, man. I just pulled a hammy here. Sorry, I got a thing. Got to wash the car. Got to feed the hogs. I'm sure. Don't think I can make it today. I'm good. If you're playing full contact flag football, I am good. Maybe there's a time in high school I might have said, "Yeah, that sounds like fun," but not at my age. I'm not even that old.
I hear you.
Oh man. Well, anyway, we're gonna get into it. Enough of our old dude antics here, but yeah, I wanted to get into a few things here. There's actually some interesting stuff in the news today, and wanted to cover a few parts. So one of them was the crash in the stock market. Now, those of you who are listening are like, "Wait a minute, there's a crash in the stock market?" Yeah, there's a crash. It's down 2%. It's an absolute, it's devastation on Wall Street. I say this obviously in jest. There's no crash, but the fact that the market has gone up nonstop all year with hardly a breather, I'm already getting. Yesterday, the market went down a little bit, and I think it was like down like 30 basis points. And I had a client text me, and he's like, "Oh my God, I guess the party's over." I'm like, the party's over? Like, that's not even volatility. Like that's nothing. You could do that in a span of 10 minutes, nonetheless, like a day, like 30 basis points, like forget about it. And I'm just laughing because, I mean, I think the market's down like 2% in the last, or maybe even 1% in like the last few days. It's nothing. It's volatility. And people are getting worried, and I'm sure there's people who are selling. Now, for reference, today is triple witching, and it used to be quadruple witching, but I guess they get rid of single stock futures, so it's no longer quadruple. Now it's just triple witching. And for those of you who don't know what that is, it's really irrelevant for 99.99% of the people. But for those people who it is important to, it basically means there's more liquidity, there's more people trading, and potentially more volatility. Because what happens is you have the expiration of futures, of options, and I believe futures options. I think that's what it is. Is that the third one, Phil?
I think so.
Yeah, there's 3 different expirations. There's equity options, there's futures options, and I think just futures. I think they all 4 times a year, I believe they all come due on the same date, and that just leads to more volatility. And what it really happens is what it does is it leads to a pegging of a price. So if, like, let's just say this is not the truth at the moment, but let's say the S&P is trading at like 5,050. And you're like a few days away from like triple witching. Well, a lot of people might have tried to use 5,000 as the number. So what they'll try to do in the days leading up to triple witching is they'll try to push the price to 5,000 so that they expire right at that number. So there's a lot of people trying to push the price to the number where it expires to, because that's the number that they sold the options to. Now, this is probably going to go over the head of a lot of people, but I'm just telling you, like, you hear triple witching, you're like, ooh, what's going on? Nothing. Don't worry about it. Just hide under your mattress. Don't worry about it. You're good. There's no witches out there. So you're all set. But for some people, for the very, very, very small people that are definitely not listening to this podcast, don't worry about it. Like everyone else, those people have to worry about it. Everyone else, you're good. But I did want to point that out because I saw that in the news today, and it seemed very inflammatory, as if the world was going to end, because not only is it triple witching, but we're down like 2% off the highs. And then you look at crypto, which I think the high at Bitcoin was what, 72, and right now it's at 68. Oh my God, the world's going to end. I mean, Bitcoin went down like 75% in like 21, and it's down like 5%, and people are freaking out, even though it went on like a huge bull run of a few hundred%. Unless you get in a few days ago, you're pretty good. You're pretty much going to be fine. Don't worry about it. I mean, ever since the ETFs went live, you're up quite a bit. I think you're up like not quite double, but pretty close to it. Maybe up 75, 80%. So don't worry about that little volatility, right? If you're watching your portfolio every day, please don't jump out your first floor window. You're going to be okay. But I did want to point it out because we are getting some people who are concerned that the market's going to blow up because it's down 2%, or in the case of crypto, 7%, which in crypto world, that's nothing. Like that's 7% is nothing. That's like daily volatility. It was up 6% the other day. Now it's down 7. Okay, so what? You're going to be okay, right? Don't worry about it. But I did want to point that out because that was one of the things that's happening. I also want to point out there was an image I wanted to share because I saw this and I thought it was actually, I always like images to try to share them on the show because why not? For those of you who are visual listeners, you'll appreciate it, and those of you who are actually watching live, you'll definitely be able to see it. So here's the image is by Chart R, but it says Bitcoin's gravity pulls the rest of the crypto universe with it. Now, if you look at the picture, it's basically the market cap of all cryptocurrencies. If you look at Bitcoin as of this March 5th, which obviously is about a week and a half ago, Bitcoin's 1.3 billion. I'm sorry, $1.3 trillion in Bitcoin. Ethereum is 456 billion. Tether is 100 billion. So on and so forth down the line. So if you look at all of those, the combined market cap, excluding Bitcoin, is 1.1 trillion. So basically, you're looking at $2.4 trillion market cap for all cryptocurrencies. That's a lot, right? But the point of the chart is that the size of Bitcoin pulls the crypto universe with it. Because I don't know if you remember, but back about a year and change ago, back at the end of 2022, Bitcoin, Ethereum, pretty much every cryptocurrency out there was in the basement of prices. Everyone thought the world was going to end. Oh, no one's going to ever invest in this again. And then what happened? It went on the biggest bull market we've seen in the last few years, and it's taken everything else with it. Bitcoin went up a lot, Ethereum went up a lot, and of course, some of the Bitcoin rise had to do with the fact that it was an ETF was coming out, which made it broadly available to everyone else. Now, as a thesis, it's interesting because if you look at Bitcoin and Ethereum and all these other cryptos, there's over 10,000. There might even be 20,000 at the moment. There's at least 10,000 cryptos out there. And what the interesting thing is that it's great, but Joe and Susie Lunchbox can't invest in it because it's complicated. I've told this story in the show a lot. I spent a whole weekend trying to figure out how to put Bitcoin into a wallet, and I just gave up. This was like, I don't know, 7 years ago. I just gave up. I actually bought like a nano, like a nano treasure or Trezor or Net Ledger, whatever. I bought like one of the nano, the wallets, because I figured, well, it's probably better than a piece of paper, which could, burn up in fire. I didn't put a lot of money in, put $100 in, but I thought, all right, let's just try this out. After a while, I gave up. I'm like, it's too complicated. Like, I'm worried I'm going to lose something. I'm going to lose my password. Like, I just gave up. So if it was that hard for me and I actually really wanted to understand it and I have a background, I understand it. I'm not a tech geek, but I'm good enough. I'm better than my dad was. My dad couldn't figure out the VCR and get that to stop blinking, but I could at least figure that out. So, the fact that I gave up, there are people that are certainly smarter than me, and there are people that are maybe not as technologically savvy as me. Let's say I'm in the middle. There's at least half the people that aren't even going to try. Um, and so when you have an ETF that comes out, it's really easy. You just click a button and you buy it. And so what's happened is a ton of capital has gone into Bitcoin because now you can buy it as an ETF. And some people claim Ethereum's next. I don't know if that's true. Who knows? But at the moment, Bitcoin is the first ETF that has come out. There's, I don't know, 6 or 7 or 8 of them out there. Eventually, a lot of them are going to go by the wayside because, like any ETF, the best ones, the gravity pulls more capital to the best ones. I think right now Fidelity and iShares have the biggest, if I'm not mistaken. I could be wrong, but I think those are the biggest. I'm sorry. If you exclude Grayscale, because Grayscale was the first, they had a closed-end fund. That may still be the biggest. I'm not sure, but if you exclude that, the other two are, and I say exclude it because they have the highest expense ratio. I think it's like 1.5%. Well, the rest are a lot lower, like a whole percent lower. So as far as I'm concerned, I think that's a dumb business model, but whatever. So they had all the capital, and then the capital's fleeing going to the others. And so eventually, if you exclude them from the conversation, it looks like Fidelity and iShares will be the winners. One of the two will get the most, and then everyone will flock there because they have the lowest fees and they have the most volume, and then they'll get options on it, and all these things kind of like gravitate towards it. So what will end up happening is you'll see these other ETFs. They may still exist, but people won't generally trade in them because they're going to go with the most liquid. So if you look at the S&P 500, for instance, most people use SPY. It's the most liquid, it's the most commonly used, and there's options on them that have the most liquidity. Now you can use Vanguard's. Vanguard has, I forget what it is, IVV. I think Phil might know better than me, but it's
VOO.
VOO. Okay. So VOO. So Vanguard has a VOO, and it's the same thing, right? And the fees, I don't know if the fees are more or less. I'm not an expert in that, but Vanguard doesn't have the same volume as the SPY does. So fewer people use it, which leads to lower volume, which leads to fewer people using it, which leads to lower volume, and so on and so forth. It's a negative reinforcement loop. This is how Wall Street works. I'm not saying don't use it. I mean, it should perform the same as any others. My point is if you're going to use it in anything other than a buy and hold strategy, then you really want to find one with liquidity. And I'll tell you, because I've looked, the VOO does not have options that you'd want to buy. There are technically options, but the spread is so wide you wouldn't touch them. It's a huge spread. And I looked at them because the SPY was getting expensive. It's hard to allocate. So I was looking, how can I get exposure to the SPY without having to put $40,000 or $80,000 into it? Just crazy. So I was trying to find another one, and the spreads are huge because no one's trading them. So the point is it doesn't matter what it is, and this applies to any ETF. And I'm not picking on any one of these. These are just examples. Any ETF, you want to pick the one with the most volume because the more people use it leads to bigger volume, which leads to smaller spreads when you're buying it, which leads to other things like having options you can trade. And it just leads to a more stable and accurate price. If you have one that never trades, there's wide spreads. And for those of you who don't know what a spread is, a wide spread means the buy and the sell price. If you're talking about SPY, it might be a penny. And if you're talking about another one, and I won't name it because I'm pulling this out of thin air. Let's say another one that has a spread of like 10 cents. Well, why do you want to waste 10 cents on a trade when you can do it for a penny? And that's the reality, right? I mean, the fees obviously impact, but anyway, know what you own. Look at all these factors. Don't just look at, well, Vanguard has the lowest expenses. Maybe, but if you're buying options, then it's not going to do you any good. Make sure that whatever you're doing, that you're doing it in the way that makes the most sense for your style. If you're buying and holding, it's not going to matter which one you buy. It should, as long as they track the index. But these are things you should know. So what are your thoughts, Phil? I mean, you do a lot of, allocation, and you spend a lot of time figuring this stuff out. What are your thoughts?
So first, I just want to go back to the triple witching. just to clarify. So it's stock options, stock index futures, and stock index options contracts. Those are the three. Uh, as far as personally, I use VOO, not SPY. Uh, I don't do options, so that part of it doesn't matter. But you're right on the liquidity. There is a big difference. I looked up the average daily volume, and VOO trades a little over 5 million shares a day. SPY trades at over 75 million shares a day, so that's almost 15 times. But SPY does have a higher expense ratio. It's 0.09%, and VOO is only 0.03%. And that does matter. And I think in a long term buy and hold strategy, to me, the expense ratio is going to become more important than that spread because I'm going to keep paying that for as long as I hold it. So that difference, it's three times as much for SPY. So in that case, VOO to me is more attractive because it's from a long term perspective, I'm going to just pay less. But those are some things to consider. Like the other things I want to talk about, we look at the market, and I was commenting to Kirk before we started. If you look at just the number of points that the S&P or the Dow or any other index or the Nasdaq, whatever index you want to look at moves, you might say, oh, it looks like it moves a lot. When we were younger, moves like we see today were a lot. They're not anymore because when you've got the S&P at 5,000, if it goes 50 points, that's only 1%. When the S&P was 1,000, that was 2.5%. So think of things on a percentage term. Don't always think about them in terms of the raw numbers. And the other thing that what you're saying always brings up to me is when I look at value and look at you were talking about how Bitcoin, the tremendous rise. Look at stocks too. And look at the difference between the 52-week high and the 52-week low. It's crazy on some of them. You can't tell me that, like I have NVIDIA up on the screen, and I know that's been a great stock for the last 52 weeks, but its low was 251 and its high is 974. So that's almost four times. But the value of the company can't really have changed by four times in the space of 1 year. Look at Apple. I looked at that one before, and it's the range between its high and low is about 40%. Again, the value of the stock doesn't change as much as what we see when we look at the price. It's just something to be careful of. I mean, that's why there's always opportunity too, because the market goes too crazy, right? The market's fallen a couple of days, you get calls, people get upset. That's recency bias too, right? We react so strongly to what we see now. We don't think about the fact that year to date, it's been a great market. We think about the fact, oh my God, the last couple of days, the market's fallen. Does that mean the sky is falling? Probably not. We don't know for sure. I always tell people I have this crystal ball that I have. It's cracked. It's cloudy. It doesn't tell me very much. So I can't predict the future, but I do know not to overreact. And I want to think of it from the long term. I tell people when we're investing, we're taking a long-term perspective. And over the long term, the market goes up. So don't get so wrapped up in what's happening on a day-to-day basis.
Yeah, I mean that's great advice, Phil. I mean, just kind of looking at some of the futures today as we're kind of looking around, and I do agree on the SPY versus VOO, right? That's fine.
Yes.
Yeah, I do agree with your sentiment. I mean, there are people who trade, and if you're trading, you should use SPY. If you're buy and hold, then VOO might be a better strategy because, like you said, the spread is different. I mean, if you're talking about 3 versus 9, realistically, that's such a small difference. It's really not going to move the needle for most people. But money's money. I mean, why would you pay more if you don't have to? So if you're talking about a 3, yeah, sure. If you're buy and hold, then VO is probably a better choice. And we talk about this a lot in the show because I think a lot of people get hung up on the fees. Like, oh, the fees, like, I don't want to pay more in fees. Like, we want the lowest fee. The lowest fee is the best situation. Well, it depends, right? People just look at things in a black and white world. Like, well, it's it's right or wrong. It's black or white. It's up or down. It's Republican or Democrat. There's no other choices. There's only two, right? We watch the media. The media gives us two yahoos on TV. One says this, one says this, and these are the only choices you're going to get. And they don't say this. And this is something that if you ever watch the news, and I don't, I said this a lot. I don't watch the news because it's like a train wreck every time you watch it. But like if you watch the news and they have like, both sides, here's one opinion, here's the other opinion. Which one do you think's right? Well, I'll tell you something. First of all, neither one is right. And second of all, there are a million other opinions. You don't need two, but they position it as if there's only two choices. So then the public gets themselves whipped up and this other one's wrong. I like this person. This person was right, even though they're both buffoons. Like this person's right. This person's wrong. Like, how about you stop and think about the fact that there are a million other choices out there? And you know what? A million other choices might be better than these two. And we don't stop to think like, hey, maybe I should make up my own mind. Maybe neither person's right. Maybe there's a sliver of what, like let's say there's a Democrat and a Republican, right? And the Republican's saying one thing. I'm like, I don't really, I'm not, like let's say I'm a Democrat and I'm like, well, the Republican's wrong. And I believe in the Democrat, but the Democrat's still kind of squirrely. Like maybe there's one or two things that are right, but there's some things they're saying. We're like, I don't know if I really believe that. That sounds crazy, but I don't like this guy, so I'm going to go with this. I mean, that's the way both parties do it, right? I mean, you've got so many contradictory opinions, but people don't usually believe in 100%, but they still got to stick with their team. This is my team. I got to stick with my team. And it's just like, look, and the media takes advantage of that. How about you stop and think and say, all right, maybe neither of these buffoons are right. Maybe neither of these people are saying what I believe in, and maybe I should make up my own mind. And I think more people should do that because if they do, then they won't get whipped up into a frenzy of all the, the circus act that the media is. But, I mean, we get off on a tangent here, but I did want to go over some of the things in the market because what's interesting, when I'm looking at the futures here, and what's interesting is if you look at, we talked about the equity indexes and they're down a little bit. I mean, honestly, it's like normal volatility down. It's nothing to be scared. It feels scary. Like I woke up and the market's down. I'm like, ooh, what's going on? Should we sell? In my gut, I was feeling that because we've had nothing but up days for so long that it just feels like, oh, the things are going to crash because we had a down day of 2% or 1%. I feel that. And I do this all the time. So I'm smart enough to know, like, I know that I'm feeling that and I know it's stupid. I'm just going to like ignore it. But if I'm feeling it, it means everyone else is feeling it. So if you're feeling that, you just need to think about what is my process? What is my strategy? And where am I going to get out? You should always have an exit when you get in, right? When you get in, you should have an exit in mind. I'm going to buy this. It goes up 5%. I'm getting out. I'm going to buy this and I'm never going to sell it. I'm going to buy this. I'm going to sell it in 10 years. Whatever your strategy is, right? There's no wrong strategy. I'm just saying everyone's got a different perspective. If your perspective is buy and forget it, I'm 30 years old, I'm going to buy and take it out when I'm 60, great. Then you should never look at your portfolio because your strategy means that no matter what happens, you're never going to take it out. So why bother? Just ignore the markets and just keep dumping it in and forget the fact that it even exists, right? That's okay, right? They talk about Fidelity did a study and they said that the best performing accounts were dead people. And you know what's funny is Fidelity is a funny company. They've come out with like 3 or 4 really groundbreaking studies that just kind of disappear. That one that came out, they actually refuted the fact that even existed. So this story came out and said Fidelity does a study and internally and said that the top performing accounts were people who were either dead or forgot they even had an account, which means they never touched it. They said those are the best performers. And then after that news story came out, they came out with a news story that said, or a story that said, we didn't actually say that. Now, I know they've done this a bunch of times where they have an internal data and research. So they come out with it and they tell their people, and then they say, oh, sorry, that didn't make us look good. There was another one they did before, which said, I heard this my first year because a Fidelity wholesaler came in and talked about this. He said, we did an internal study that showed that Fidelity Magellan, which was the best performing mutual fund for like over a decade in like the 80s and some of the 90s, it was before my time, where they did this study and the best performers, what they found was the people who just bought and hold, you had the best performing mutual fund. It was great. But most investors actually performed, they got a negative return. Most people investing in the Fidelity Magellan actually got a negative return. And the reason is they would get in when it was up high, and then when it dropped, they would get out, and they would get back in when it's high. So they basically were they were buying high and selling low, which is a recipe for disaster. So that study, which I thought was brilliant. And I wish they came out with it. And I asked them for a copy, and they said, no, that doesn't exist. They just ignored the fact that they came out and even said, I mean, they do this all the time, but they do come out with brilliant stuff. I just wish they would admit it, because it's actually to their benefit to say, yeah, we came up with this study. Like, it's great. But they just, I don't know why they don't admit it's weird. But anyway, you should just know that. I did want to point out a few things, and then I want to dip into another area. One of them is looking at the markets. I'm just going to broad brush the markets and what's going on. So the equity indexes are little off all-time highs. You've got the Nikkei, which we talked about in the show, broke out to all-time highs, and then it went back to all-time highs. I think it peaked out and then came back. I'm not sure where the peak is. I have to look, but on the charts, it's come down a little bit. And it broke out right around the time that they were going into recession. They announced we're going to recession, then it broke out to all-time highs. Is kind of how the markets work. Euro stock is up. Basically European stocks are doing well. The VIX is within norm. But then you've got stuff like natural gas, which is at a really low price. It's really in the doldrums right now. And just something to keep in mind. I mean, if you're trying to heat your home, I know the weather this year, there's been a lot less of it, but it's really dropped a lot, which is interesting. And then you look on the other end of the spectrum, you got cocoa, which, for chocolate, it's going through the roof. And if you look at companies that use that, like chocolate companies, for instance, are getting hit hard because of it. So, I don't really follow the cocoa market, but it's interesting because when you see stuff like this, and I'm going to use this as an example. So let's say you see cocoa, for example, which is used to make chocolate. You see that spiking higher, and I don't know if it's at all-time highs. I don't have a chart in front of me of what the let me see if I can bring it up. Yeah, I mean, at least for the last. Well, anyway, I don't have a long enough chart here. There it is. Yeah, if I go back for the last 25 years, the highest it's gotten is 3,700. Right now, it's at 8,140. So we're well above the spectrum of what's normal. And so the way you should take that is, okay, obviously there's a problem here, but also there's an opportunity, right? People talk about the Chinese symbol for what is it? Opportunity is the same as crisis. I don't know if that's true or if that's just stupid people memeing things that aren't true. But anyway, I don't speak Chinese. For those of you who can correct me, I'm just admitting my ignorance. But if you look at the cocoa prices and you look at some of the companies that produce chocolate, you might say, well, actually, there's an opportunity here because the market already knows that it's going to be really expensive right now to make chocolate, and maybe some of those companies aren't doing very well. Isn't that interesting? Are they bad companies? Nope. I'm not going to say the name of one of them because I don't want to get myself in trouble with the regulators. But there is a single company which I do follow, and they haven't done very well because of this very reason, that the cocoa prices are almost 4 times what they normally are. And so that's a problem, right? Now, if they've hedged this in the cocoa market, then it's not going to matter. I don't know if they're hedging, but if they're hedging, then it won't matter, right? But if you look at the price and you say, wow, isn't that interesting? I would watch this price closely, because if it keeps going higher, at some point, the stocks that get affected by this are going to get dinged enough where they might actually be in buying range. You might say, okay, the stock market's expensive everywhere, and this one industry could actually be one of the few areas where there's opportunity. So that's how you should analyze stocks. You should look at something and say, what is interesting? All-time highs. The stock's probably getting beat up. Great. This is an opportunity. Let me watch a handful of companies. Let me go through them, filter them, figure out, like, all right, I don't know how many there are. Let's say there's 5 companies. All right, out of the 5 companies, which are the best? Which are the best of the breed, the blue chip of this industry? And then you look at the rest and say, all right, or maybe some of them are beat up more than others. But I would say, I don't know much about the coca industry or the chocolate industry, or I only know one company. I haven't searched this. I'm just doing this live. But I am eyeing one, and I'm like, all right, so I'm going to watch this. I know it's a blue chip. It's on my watch list. By the way, everyone should have a watch list of a bunch of stocks that if it gets low enough, you should buy. And I'll give you an example actually. So in 2022, I had my watch list. Everything was getting beat up. It was down 35%, whatever it was. And some companies were down a lot, but let's say the index was down 30, 35%. And I had a watch list and I'm looking, I'm like, oh, none of the stocks I'm watching hit my numbers that I would buy if it's cheap enough, except for one. One stock hit my numbers. And I'll tell you which one it is because I didn't buy it. I didn't recommend it. And it's a failure on my part. It hit the numbers and I was like, you know what? I don't like the prospects for the company at the moment. And that company was Meta. The company actually got cheap enough fundamentally in my metrics to buy. And I didn't buy it. And I didn't buy it because what was going on at the time, they were getting dragged through the mud and their ad platform was getting, tossed around because Apple came out and said, we're not going to give you the data. There was a lot of things I'm like, well, I don't know, that's going to really hurt the company. It actually hit the metrics that I look for to buy. I didn't buy it. You know what happened after? It's up like 200%. Stupid on my part, right? And I like talking about my failures because hopefully other people can learn from them, right? I don't talk about them all the time because everyone will think I'm stupid, but I do like to share them, and because we all have them, right? And most of us just ignore them. They just say, "Oh, it's not a failure. I just, it was something else happened." But it was a failure on my part. I didn't live up to my standards. I should have bought it. Should have went, full boat in, got a full position, and we would have done very well. And I didn't do it. And so I take that and now that goes in the back of my brain. So next time something like that happens, I say, you know what? I should buy this. I have a strategy. I should buy it. And, you know, and because of that, even if I make a mistake, I did it for the right reasons, where I had my methodology, I followed it, and whether it turns the outcome is not something you can determine, but I followed my system, and I feel good about following my system because Meta could have gone down 50% from there. I don't know, but it obviously didn't. It went up a lot. But I had a system. I didn't follow it in this case. Made a mistake. No one's going to know about the mistake because you didn't lose money. You just didn't get the gain. But I'm saying it because we don't frequently talk about the losses that don't show up. And the losses sometimes are a loss of opportunity. So I lost that opportunity. That's my mistake, right? Now I made some gains, right? And bought some other stuff that did well. But the point was I lost that opportunity. And that's the mistake. That's going to haunt me for a while. And it's going to stick in the back of my brain because I forced it there. And every time this comes up, I'm going to be like, shit, I missed that thing for Meta. I'm not going to miss the next time. So bring it back. Look for opportunities. The market does not have many. The market is overpriced in so many areas, but there are areas where it's reasonably priced. Now, this company I'm talking about is not at a point where I want to buy it yet. It's still kind of expensive. Now, it's not expensive compared to itself, but it's still kind of expensive. So I want it to drop another 20% before I buy it, but I would consider buying it if it turns around because it should catch up to the market. And the fact that it's not cheap enough, I would say, well, it's not cheap enough, but if it starts to take off, I'll probably ride it because it is a good company and this is cheap enough where I'd probably get a position. But anyway, I don't want to get into the weeds. But point being is this is an opportunity. Okay. I'm going to share the screen here really quick and show you the coca prices so that you actually see how crazy this is. So here's the coca prices. If you can't see this, you're blind. I mean, this is obnoxious, this chart. It's such a spike. And this does happen in commodity markets. And I'm not going to get into why, but I'm just saying, like, you should be watching this. Okay. You should be on the lookout for all of these things and say, all right, here's another example, natural gas. Okay. Natural gas right now is in the toilet. Okay. If you look at these spikes, it's gone up as high as in the 14, 15 range. Right now it's at $1.65. It's in the toilet, right? It's gotten lower, but not much lower in the last 25 years. I think the lowest it got was in 2020. So we're kind of close to 2020 lows. So you should ask yourself, what's a good opportunity here that I can take from an extreme price? So natural gas is at extreme lows. Maybe it goes lower. I don't know. But I'm going to start looking for stocks here. So you might want to look at stocks where, hey, it's really cheap. Who produces natural gas? Can you take advantage of a low price right now because you're locking in these low prices? Now, you might try to buy natural gas. I think that's kind of a questionable thing to do. Some people do it, but I would start looking at, and Phil can chime in on this because Phil's the expert in the energy space, but you might want to start looking at opportunities in natural gas because it's really cheap. And you might say, how is this going to affect my investments? Is it going to be, hey, this company can hedge this price for the next 20 years and they got low natural gas price for the next 20 years? Like that's how Southwest got started. They hedged the oil prices at really, really low prices out, like I think it was like 20, 25 years. And they locked them in. And that's how they became profitable initially. And that got them off the ground. So you should be looking for opportunities for how these low prices fit in. And I'm just going to touch on one quick thing, and then I'll give it back to Phil. Natural gas. I mean, you look at some of these. People talk about gold, but I do want to point out gold because it is in the news and people are talking about it. I think give it back to Phil. But I mean, this is a gold price. I mean, gold's been going sideways for pretty much the last 4 years, and it just broke out recently. It's come down a little, but it's broken out. So from a technical perspective, this is something you should pay attention to. And those of you who are not technical traders, you can just ignore what I'm saying. But this is actually a good sign for gold. And it has nothing to do with fundamentals. It has nothing to do with anything else. It has to do with the fact the price is the final arbiter. And the price is the price. You can't argue with the price. So if it's going higher, you might not know why, but you should watch it and pay attention, because if it breaks back down below, that's a bearish sign. If it doesn't and keeps going higher, then it's a bullish sign. So anyway, Phil, back to you.
You gave me a lot to talk about there, Kirk.
Yeah, I always do. I try to make it interesting here.
So first, I'm going to just talk about when you're the idea that the mutual fund investors and the fact that they miss so much of the gains. If you're in the financial advisory industry, you probably didn't know the name Carl Richards. He's a well-known financial advisor. There's a presentation he's done, and he talks about, like, if you go back to 2008 and you watch how people reacted before the market fell, we were buying mutual fund stocks, whatever you want to call it, at record levels. When the market was at its low, that's when people were not buying at all, which should be. He equates it to like going into the car dealership and you want to buy a car, and they say to you, "You're in luck. We doubled the price." And you say, "Great, I'll take two." That's kind of how we buy stocks a lot.
So true. So true.
It is. You talked about process. And one of my favorite things on process, Michael Mauboussin is a well-known person when it comes to market strategy, talking about what makes the markets go and all that. And he has a little chart that I love where he talks about process and outcome, right? And if we're always changing our process, we never know what causes our outcomes. We have no way of knowing. And so he says, like, you can have good process and a good outcome, right? And that's your desired result. But you could have a good process and a bad outcome. That happens. It's bad luck, but it happens. You could have a bad process and have a good outcome, and that's just dumb luck. And you could have a bad process and a bad outcome, and that's kind of deserved, right? But it's important when you're investing to have a process and stick to it. You talk about both sides, and we listen to certain people. I think it's gotten so much worse in this day and age because now we have social media, and you can find somebody that has your viewpoint, and you can just go listen to them, and then it reinforces it, and you don't even see the other side. And so we get so much confirmation bias because all we're looking for is people that agree with us instead of trying to understand the other side. And I know when I'm looking at stocks, I always want to try to understand those that don't have the same opinion as me, because I want to see, what did I miss something or not? I want to understand that other side other point of view. I don't want to just look at only people that agree with me. It's really important that you do that. Um, you talked about that about cocoa. That company's down about 30%. I assume I'm thinking of the same one you
Yeah,
are.
you are. Yeah.
And you talked about if they hedge or not. So that's something, if you really want to do your research, look at the footnotes in the financial statements. Because if you go to those footnotes, it'll tell you if they hedge their prices or not. And you want to know that because that has a big impact on how they're affected by what's going on in the market. Um, you know, one other thing, you talk about learning from your mistakes. I'll never forget one of the first things I did as an investor on my own was after my mother passed away, and she passed away from breast cancer. And there was a company, a small little biotech. They had a new drug that was for cancer treatment. And after seeing what my mother went through, I was like all over it. Like, this is a great opportunity. I got to buy the stock. And it didn't do well at all. I lost money on it. What I learned though, and the reason it didn't do well, is there wasn't really a big enough market for the product that it had. It's great to have a product, but there has to be a market for it. So that's a lesson that I learned that's carried through. You can learn a lot from your mistakes. So now when I look at a company, I want to make sure that I understand what the market opportunity is with us. And then the last one you mentioned, natural gas. So just to give you an idea, we have oil right now at a little over $80 on an energy equivalent basis. You take the price of natural gas and you multiply it by 6, and that's the equivalent amount of energy that a barrel of oil produces. So you've got $80 oil and you've got about $10 natural gas, because if I take that 165 and I multiply it by 6, that gives me 990. So if you want to look in that space, so one thing that I recommend from being an analyst covering it is understand the cost structure of the company that you're looking at, because that makes a big difference in terms of how those companies are going to do, how they're going to survive. Understand their cost structure, understand if they're hedged or not. That makes a difference because it can go both ways when you hedge, right? You can not be able to, sometimes you can get hurt by hedging. Sometimes you can get help depending upon which direction the prices go. But with where natural gas prices sit today, it does seem like there's an opportunity there. I love the idea that you're bringing up of looking for sectors or areas of the market where when the market's going up, the fundamentals for them are going the other way. And so that's really opportunity, right? You want to look for opportunity. Don't just jump on the latest thing. Oh, this stock has done great, or that stock has done great, or my friend owns this, or somebody down the street owns that. Do your own research, do your own thing, and try to be contrarian, because a lot of times being contrarian can really help.
Yeah, no, I think that's a great principle, Phil. I mean, being contrarian in the market, and this is the example we used of the company we can't name. Um, that's an example, right? Being contrarian. Most people want to invest in Nvidia because it's a high flyer and because every Tom, Dick, and Harry's talking about it, right? And I say the name because everyone knows. Like I'm not telling you to buy it or sell it. I'm just saying like it's just the reality. Like everyone's talking about it, and it's up some ridiculous amount. I don't even know what it is this year, but it's up some ridiculous amount. Like, is it the best thing to buy? I'm like, I don't know. Do you like jumping on a rocket ship? Like, I don't. Like to me, like I'm not a gambler. I'm an investor. And people who are jumping on that, I'm not saying it's good or bad. It's not my style. Like some people, that's their style. They find something that's moving and then they jump on it. And there's good and bad. The good is you can make lots of return. The bad is you can lose lots of money because it goes both ways, right? If the volatility is 20%, like, yeah, you can make 20% or lose 20%. Like if you're into that game, more power to you. I'm not. That's not my style. I'd rather find slow and methodical ride up. And there's some industries that like no one invests in, like property casualty insurance. Like no one touches that. The only people touch is like Berkshire because they know the name and Warren's a popular guy. But there's a whole industry that also is good and they do a good job and no one talks about it. And frankly, analysts don't understand it because it's really hard to analyze those companies. So people just don't touch it. So it's not bad. Like it's a good industry, but it's really hard to analyze for most people. And so, if you look at mining stocks, same thing. Like I don't mean to pick on insurance, but like mining stocks, like how do you value a mining stock? You can't do it by PE, because you got a bunch of stuff in the ground and you got to pull the stuff out. So there's a whole bunch of things that come into play. Like, are there a bunch of cuckoo environmentalists, picketing the mining company? Do you have a president that says, you're damaging the fish in the stream, even though the EPA has already said it's okay and you've gotten all the clearance and you're doing, like these are all things you don't know. Like you just, you get a new president. Like one side says okay, then a new president, oh, that's not okay, and I mean, it's just all is grandstanding. But these are things that you can't predict, right? And I'm not a mining expert. Like I don't like I have access to mining experts, but I'm not one. So if I want to invest in mining stock, I go figure out what they're saying about it, right? And just figure out like, all right, is this good or bad? But generally, like that's not my expertise. Like I'm good at certain things and I'm not good at certain things. And if I'm not good at certain things, I find people who are, and then I use them as the expert, right? And I ask them questions and like, what do you think of this? What do you think of this? And it's just people always ask like, oh, how do you get your news? How do you get your information? Like, I don't know. I've built it over years. Like there's no like news shop. You walk in and be like, oh, I'll take one of these and one of these and one of these. Like, I wish that existed. Unfortunately, most news is untrustworthy. So you have to find your own sources that are reliable. And when I say reliable, I don't necessarily mean right. Reliable is somebody who's always going to, that they do a good job at what they do. Now, for an example, I have people who are consistently wrong. That is very valuable to me. Say, why is that valuable? I'll tell you. It's valuable because if you're flipping a coin, you have a 50-50 odds of getting it right. Now, if I have a friend who is wrong 75% of the time on coin flips, that's valuable because now I just go the other way. I just pick the opposite side of what he's doing. It's just the same as being right, right? It's just you have somebody who has really bad luck. That's okay, right? And I think they call those coolers in Vegas, where they just sit them by somebody who's got luck, and they put the cooler in there, and he just like ruins everybody's mojo. But the reality is like that happens. Like some people just have bad luck. They're just really good at picking the wrong thing. That's a valuable skill. Not in the way that you think, but in the way that you can look at them and say, all right, this person says this, they're probably wrong. So let's look at the other side a little bit more closely. And so if you have these sources of information out there that you can pull on, there's a lot of permabulls, permabears. I just saw a great podcast with it was a debate between Peter Schiff and Raoul Paul. And I have to say, you can listen to yourself. One of them sounded like a total buffoon, and I'm not going to call him out on this show because I don't want to get sued. But one of them did, and you can decide which one that is for yourself. I mean, it was laughable. And so when you look at these people, and one of those people, I already know that about that person, so I never pay attention to that person because I already know that they're kind of like a permabull kind of mentality. Like, I don't care what you say. I'm gonna keep parroting the same thing regardless. It's like, oh, if gold goes down, well, oh, gold's down, buy more. Gold's up, buy more. Like it's always buy more, buy more. And by the way, buy some for me. Like that kind of a thing. Like those people exist, and you just need to be able to see through the facade to know, like, is this person talking their book? And I don't mean to pick on this person, and I didn't name them, but because a lot of people do this, and it's common, and you have to be able to filter through this. There are permabulls, there are permabears, there are gold bugs, there are crypto bugs. Like there are all these people out there, but if you can't differentiate one from the other, you're going to have a hard time investing because you're not going to know when there's a deviation from it, right? If somebody's always pro crypto, you're not going to know when it's like, all right, things are getting a little hot, because they're going to just say, oh, let's buy, as Phil said, like the only place, oh, a car dealer, oh, it's high, oh, let's buy twice as much, like it's just, but you have to be able to discern right from wrong. And this is what we talked about earlier. This kind of brings it all back from earlier. Like, if you can't discern one from the other, if you can't realize there's not two opinions, there's millions of opinions, then you're going to have a hard time investing successfully. Because if you can't make up your own mind, then you might as well just be a buy and hold investor, because it's hard. I mean, Phil and I do this full time, and it's hard. So most people are like, yeah, I'm going to spend 5 minutes, look on Reddit, and be like, yeah, I'm going to pick that stock, and I'll make millions of dollars, like that Dumb Money movie. It's just a bad idea. Like it's a hard thing to do. and you have to spend the time. You have to come up with your own investor psychology, your philosophy. You have to have systems. All these things are important. And that's what we try to educate people in the show, to make sure people understand, like, this is a hard thing. You need to have these certain frameworks to have success. And so we try to provide you these frameworks and mental models. So every week we try to do a segment. We don't call it out, but a segment on mental models and how to think about investing. We don't want to tell you what to think. Our job is not to tell you what to think, because inevitably someone is going to take that and it's not going to align with their own investor psychology, and they're going to lose money. So that's why we don't tell people what to think. We just tell you how to think, and then you can make up your own mind. Mental models are the key. And so that's what we try to do every week in the show. And Phil, we're going to wrap it up here in the interest of time. Final thoughts, and where can people find more about you?
So just two things. One is it's funny you talk about like listening to what other people said and all this. And the other day, my son comes to me and he was looking on Reddit, and somebody had this option strategy. He says, I can't lose, right? Because the stock hadn't hit that level in a long time. Well, first of all, he didn't realize how much money he would have to put up to buy that number of options. Second of all, there's never a sure thing. And if you look at the return he got relative to the amount of capital that would be at risk, it wasn't worth it. Even if you thought you were going to hit, what if it doesn't? And now you've ruined your life if you have the kind of loss that he could have had. The other thing is, I often get, or not that often, but I get emails sometimes from clients because they read somebody that's usually it's a perma bear, right? Because that's what scares people.
Mm-hmm.
Oh, I read this. Is this true? My first thought is I put that person's name into Google and I look and say, here, they've been saying this all these times. Are they right? I don't know. They could be, because even a broken clock is right twice a day. But I'm not just going to take what they say, because that's what they're out there doing. They're trying to, they're fear mongers. They're out there trying to scare people. They say this all the time. Yeah, sometimes they're right, but more often than not, they're not. And just understand where it's coming from and the person that's giving it. So you look, these guys, they're there. I'm not going to name any names, but there's plenty of them that are out there, and they're always saying the same thing. They're always singing the same story. It's doom and gloom. So just be careful. Always do your own research. As for me, I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's at Prize Wealth Management. You can download my free ebook, How to Flourish Through Life's Big Changes, at prizewealth.com/ebook. And you can also go there and sign up for my blog. Thanks for having me today, Kirk. Enjoyed the conversation.
Yeah, thanks for coming on, Phil. Always enjoy our conversations. This was good. And that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your money, we make your life better. You can also find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're new on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shorting and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send an email and express your feelings. If you're seeking financial advice, talk to an oracle or fortune teller, maybe just a licensed financial advisor. I'm one. As I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.